Assalamualaikum and good day to all of you. Our topic for today is double taxation relief. Before we go further, let's understand the concept and definition of double taxation relief. So double taxation means levying of tax by two or more countries on the same income. For example, if you receive the income from country A and then you bring back the income to country B. So country A probably has imposed the tax on the income that you received, and then when you bring back the income to country B, which is your resident country, you probably need to pay again the income tax on that income that you bring back to your own country. Alright, that is why you need to learn this topic in order to know how to reduce the burden of double taxation. Okay, next. In Malaysia, there are two ways to reduce the burden of double taxation. The first one is called bilateral relief or bilateral credit, and the second one is unilateral credit. Okay, before we go further on the calculation part on bilateral and unilateral credit, I would like to share with you all on four types of businesses that is subject to world scope of income. Okay, mainly in Malaysia, we use territorial scope, which means that only income derived from Malaysia will be taxed in Malaysia. However, for this type of businesses, they are subject to world scope of income, which means that wherever they derive the income, they need to report the income to Malaysian government and pay Malaysian tax. So these four types of income is more they are more exposed to the double taxation. Okay, but other income is also probably is subject to double tax on certain circumstances. So these four businesses are insurance business, banking business, air transportation, and sea transportation. If you see, you can imagine their transactions, right? For example, insurance business. Okay, let's say you want to travel to somewhere, you will take travel insurance. So that travel insurance probably you take in Malaysia, but then you travel to overseas, and then if something happen over there, then you can claim from the insurance to pay on whatsoever. So the insurance business is mainly international business. And then banking business also, you can imagine people transfer money to other countries, people purchase products from overseas and then pay through banks and financial institutions. So they are also doing international business. And then air transportation such as AirAsia or Mars, you can imagine that they fly from Malaysia, Kuala Lumpur to other countries, and from other countries to other countries as well, right? And also sea transportation, where normally we use this uh, to ship products from one country to other countries. Okay, so if you want to learn more about these four types of businesses later next semester or next semester, you can take a specialized taxation. Alright, now we come back to double tax relief on the calculation part. First, we want to see the difference between bilateral and unilateral credit. Under bilateral credit, actually, Malaysia has a tax agreement or double tax agreement with the country uh, on bilateral credit. Whereas under unilateral credit, Malaysia do not have any double tax agreement with that country. Okay, so bilateral cover under Section 132 and unilateral cover under Section 133 of the Income Tax Act. On the calculation part, relief under bilateral, we compare between tax payable in the foreign country, which means that tax that the person has paid on the income in the foreign country, with Malaysia tax payable on that foreign income. Okay, so that income bring back to Malaysia, how much is the tax on the income in Malaysia? So we compare and we take the lower amount as the reliefs. Okay, whereas under unilateral credit, we only compare half, okay, half of foreign tax paid in that foreign country with the Malaysian tax on the income. Okay, meaning that Malaysian tax on the income full, but we compare only half of tax paid in overseas. Okay, and we take the lower as the reliefs. So this means relief under unilateral is normally lower than the bilateral if half of the foreign tax is lower. And then the definition of foreign income. Under bilateral credit, foreign income also includes not only income that you derive from overseas, but also income that you derive from Malaysia. But the income is suffered the foreign tax. This thing can happen where probably you have performed some services or work for a foreigner, then that foreigner pay to you. Before they pay to you, they probably withhold a certain portion as their tax from their country, meaning that whatever you receive is net of their country's tax. So in that case, you can apply also bilateral credit to reduce to get back the tax that you have paid, not get back, to reduce the burden of paying double tax on that income. Okay, whereas under unilateral credit, the foreign income do not include that income derived from Malaysia. It is only means income derived from outside of Malaysia only. Okay, so this one is on employment exercise outside of Malaysia, also applicable under unilateral credit. You can read the textbook further on this thing. Okay, let's go to next slide. Okay, this is the formula of bilateral credit, where the foreign tax you compare with Malaysian tax on that income. So in order to know Malaysian tax on the foreign income, you need to do this formula. Take the portion of foreign income, statutory income, okay, take the SI, divide by total income that you have calculated, and then times the Malaysian tax payable. Then you will find the portion of Malaysian tax payable on that foreign income. Then only we compare with foreign tax paid in full. So whichever is lower is the reliefs. Okay. Under unilateral reliefs, since the definition of foreign income is different, okay, foreign income we just take gross amount. We don't have to calculate the SI. Okay. And then we divide by total income and times Malaysian tax payable, so that we know the portion of Malaysian tax on that foreign income. Compare with foreign tax, but only half of it. Okay, half of it only. So whichever is lower is the relief. Okay, now let's see a full example. Alright, this one is example on bilateral credit. Fikas Nebrahat has the following income. Gross business income from China, gross business income from Malaysia, rental income, and allowable business expenses. So business is for business. So what you need to do now first is the computation of tax payable. Take the business income first, because business income come from section 4A. So the total gross business income here is 575,000. And then because the question given to you do not split between allowable expenses in Malaysia and China, therefore we just lump sum deduct here and we get the adjusted income. And here adjusted is also the statutory because there is no information on capital allowance. Okay. Then only we add rental income to get the total income, and then we apply the tax rate of 24%. Okay, business or company tax rate is 24%. And also please remember that in China we have paid 10% for business income from China, which is 7,500. Okay. First you need to find how much is the tax, Malaysian tax on China income, because China tax is already understand here, 10% of this one. 10% of 75%, 75,000. This 75,000 is gross. So the tax is 10% times 75,000, which is 7,500. Okay. So now the formula for reliefs is foreign income, SI. Okay. So here we only know gross, foreign income. We do not know SI, right? SI here is total. Therefore, we need to split this total to China. How much is the China? That is why we take the China gross, divide by total gross, and times total SI. So we will get China SI only. Okay, so take this and put into this formula. Okay, so we take the SI from business in China, divide by total income. Okay, this one go here. Alright, and times the Malaysian tax payable. 124,800 is here. Okay. Okay, so you will get 15,495.59. This one you compare with tax paid in China. Okay, 7,500. So whichever is lower is the relief. So which one? So this one is lower. So this is the relief. So where we will deduct this relief? Okay, there is one more example here. This one is simple because under this example, everything is given. This one is insurance company, the income from net premiums, and then allowable expenses given, and then other incomes, rental, dividend, interest from Malaysia, and interest from UK. Total income given, income tax 24% also given to you, and withholding tax in UK 10% put also given. So you just apply to the formula. Foreign income, take this one, 100,000, and then total income is this one, and then Malaysian tax payable is this one. Okay, this one. Okay, so you will get 239,998 compare with tax paid in UK. Whichever is lower is the relief. So where to deduct these reliefs? Okay, this one is example 3, which final exam standard, which comprise also bilateral and unilateral. Okay, so let's see. Equanimity Shipping Berhad is a Malaysia resident company, and then they reports the following income: Malaysia income, adjusted business income, rental income, royalty income, and dividend. New Zealand, we have dividend income, commission income. Lesotho, interest income and consultancy fees. Okay. Additional information, capital allowance for 2019 was 85,000. Malaysia has a double taxation agreement with New Zealand but not with Lesotho. So meaning that this one bilateral, this one unilateral. Okay. Taxes paid on the dividend income and commission income from New Zealand were 5,000 and 3,000 respectively. Taxes paid on the interest income and consultancy fees from Lesotho were 6,800 and 5,500 respectively. Okay, required compute the tax liability for Equanimity Shipping Berhad for the year 2019. Okay. And also you need to consider all the reliefs qualified or available under Income Tax Act. Okay, so you display your answer according to sections. First, section 4A, we have business income, adjusted business less the capital allowance, so that we get the SI here. Section 4C also list down Malaysia exempted, but from New Zealand you need to report because Malaysia exempted because we use single tier system for dividend. Okay. And then interest Lesotho also you need to report. Section 4D, rental income and royalty from Malaysia. Section 4F consists of commission from New Zealand and consultancy fees from Lesotho. So now we get total income of 891,000, and then we apply Malaysian tax 24%. Then we can apply the reliefs of bilateral and unilateral. Bilateral is for New Zealand and unilateral for Lesotho. Okay, the formula is tax paid. We want to know the Malaysian tax on the foreign income, right? So Malaysian tax is 213,840. So you transfer to the formula. Okay, better in the exam you can write the formula first and then you apply the formula. Alright, so this one is the Malaysian total tax. We want to know for New Zealand only portion of Malaysian tax on the New Zealand income. That is why I need total income. 81 come from here. Okay, this one is the total income. This one pun same. Alright, this one also total income. 45,000 is the foreign income. Bilateral should be the SI, foreign income SI. But in this case, since there is no information related to expenses or whatsoever, so this is also the SI. Okay. 45,000 divided by total income 891,000 times the tax, total tax 213,840, then you get the Malaysian tax on that foreign income. Compare with whatever tax paid in that country, which is in this case 8,000. Okay, so take the lower, which is 8,000 as the reliefs. Put here and put bracket. Unilateral relief for Lesotho because we don't have agreement with Lesotho. Take the gross amount or income from overseas. Okay, this one. Divide by total income 891,000 times the Malaysian total tax here 213,840. So we get 16,320, which is Malaysian tax on Lesotho income. We compare with only half of the foreign income, which we get 6,150. So whatever the lower is the reliefs. Okay. So in this case, 6,150 is the reliefs. Okay, put here, and we can now calculate what is the final tax payable. Take this one, 213,840, deduct bilateral relief, deduct unilateral relief, and finally you will get tax payable, final tax payable of 199,690. Okay, with that calculation, the main part of this chapter has delivered to you. Think big, start small, learn fast. Thank you.